you've already met Mike and Patrick on our audit team, and Andrew, our senior manager. And this is Jane Liu. You haven't met her before. She's with our TS department, and she's going to be helping with our with your recent Bow Wow acquisition, accounting for that and some other issues. And I also wanted to give you, to start out, this is an agenda for the meeting. Or this is the agenda for the meeting. And this is a list of issues and our position on them that have come up. And so that is just for your reference, so you can look at that. And I also want to start out and say that if you have any questions during our meeting, please feel free to call them out, and we'll answer them as best we can.
All right, so to start things off, I just want to say that we're here to work with you throughout our entire audit. We went and tried to pinpoint any potential areas of weakness, whether it be control deficiency or a process design issue, so that we could work through with you today, right now, and talk through those issues and hopefully resolve them going forward. So the first primary area we'd like to focus on is the background investigations. As you know, this is a crucial aspect to the onboarding process, and we view potential areas of weakness, it's twofold. One is the process design itself, and the second is the role of the board in that process. As you may know, the onboarding process, typically, it must be completed 6 months prior to the onboarding of the actual new hire, both the preliminary by HR and the approval of that, as well as the board approval. However, with the recent onboarding of the CFO and the new COO, Ms. Lopez, Mr. Tanner, that protocol was not followed. The HR cited that they were just overwhelmed with the amount of influx with the new executives, and they didn't have the resources or the wherewithal to complete that. And the board said they didn't see any glaring issues, so they were just going to go ahead and bring them on as well. And while there is no formal literature that states or mandates that background checks must be completed, the Fair Credit Reporting Act does encourage it, and given the dynamic nature of the company with the new you as the new CEO as well as the new CFO and COO, we think that you're going to be heavily scrutinized in the public eye, and it's in your best interest and in the best interest of your shareholders to follow through with the protocol with the background investigations.
What did our HR director say about that?
Like I say, Mr. Miller said that he did not see an issue. He thought that there were no glaring issues and that he would get to the board approval process when he could, but to go ahead and go forward with the process. To help resolve that, we think that a reallocation of your resources is in order. Rather than provide more or hire more HR staff, we feel that this is a temporary issue, and so the best use would be to either leverage your internal audit team or the board itself to have a more active role in the onboarding process.
So is there, I mean, obviously it sounds like they're not in compliance with our policies, but is there an impact to the audit related to this?
No, the only potential area of concern is that the CFO must sign off on all your financial statements. So if he's not properly vetted before that process and something comes out, it can have a significant impact on your financial results. And
I just wanted to tag team off that and add that just part of the role as the audit committee is just risk oversight, and that the background checks, checking in on that on the management team. Part of that is, you know, I guess what you guys are trying to do. So no direct impact, but just to keep in mind that this is going on, and to oversee this management team and their financial reporting. And I was just going to come off of Andrew. You guys also asked us for audit committee guidance, and I was going to help out with that. And so due to some of these pressures that your company has been facing, some changes in the management team, and some other uncertainties, and your steadily growing size, we just wanted to make sure we're thorough and we get it right regarding your leadership and your audit committee, and provide our experience on that issue. So for some authoritative guidance on the audit committee, Sarbanes-Oxley Act of 2002 highlights a couple important points for the audit committee. First is in section 301, that of independence. And it states that in its definition of independence, it gives that the audit committee should not be compensated by Fox Corp, and it should not be affiliated or related to Fox Corp, being employed or a business partner, related party. It also highlights the need for an experienced financial advisor on the team, on the audit committee. And lastly, it's just good business sense for the people on the audit committee to have relevant experience and knowledge of the issues. So in that light, we just wanted to make sure, because of the critical role of the audit committee and its role in overseeing the financial reporting process, we just wanted to emphasize that. And I also wanted to give you, this is PetSmart's audit committee, and I'm sure you guys have worked with them before. We just thought that would be a good visual representation of an audit committee, and I just wanted to point out their independence from PetSmart and their experience. You can tell that all of them have served on the management team in some capacity. So I just wanted to conclude by saying we strongly recommend reassessing your audit committee for the benefit of your future, of your company,
Are
as you
there
highlighted.
specific people on our committee that you currently think we have a problem, that they would be a problem?
I was just going to give you kind of an idea of what an audit committee should look like. Again, that's your determination. It's not our role to tell you, this is what your audit committee should be. But I'm just trying to give you my advice to the best of my ability, leverage our resources, and help you with that. And another thing I wanted to help you with, or we could help you with, is the audit committee charter. Maybe take a look at that. I think we can provide advice, and I think I also have with me PetSmart's audit committee charter, just as another example. Again, you don't have to look at that now, but that's just something that you can look at going forward, and take a look at how they approach their audit committee. Because I think as your company is growing, this will be an important issue for you. So.
Yeah. And if you guys have no further questions on those, Patrick and I would like to discuss a couple of the findings we had during our audit testing. The first of which would be an error we found in the testing for allowance for doubtful accounts. It was a $34,500 understatement.
It's so small you can't even say it.
Yeah, no, I know. It was a computational error that was found in your system. We went and spoke to your system CFO, and he said that typically these documents are not tested for accuracy when they're produced. And then we also went and talked to the IT department to let them know of the issue and see whether this is kind of an isolated incident or whether this is something that might be a little more widespread.
Yeah, so in this case, as you can see, the dollar amount is kind of insignificant, which, I mean, given our scope,
Yeah.
yes, we consider insignificant. However, what's more important is the controls that are in place to help prevent, detect, and correct the errors like this.
Yeah, I mean, Patrick's absolutely right. So our recommendation is that we go through and look at the internal controls that are in place to make sure that they are there and that they are actually enforced as well, to make sure that the accuracy of these documents is checked, so you guys are making decisions based on accurate information. We also want to follow up with the IT department to make sure that everything was corrected and that this is just a one-time glitch, to make sure this is not a more widespread issue.
Yeah.
And lastly, we don't request that you do make an adjustment. If you want to, that's certainly okay, but we're not going to require it from you.
Now, on the other hand, in the course of testing, we did find something that we do consider significant, which was the contingent liability. Now, this was the complaint filed by a consumer, which alleges that the dog food purchased by the consumer was tainted during the production cycle and causing injury to the consumer's dog. Now, in cases where there is injury caused by a product sold, according to U.S. GAAP, there are two criteria that need to be met in order to record a liability. And the first criteria is that the information needs to be known prior to the issue of the financial statements, and that the likelihood of this loss is going to be probable. And the second criteria is that the loss needs to be able to be reasonably estimated. Now, I understand that there's kind of a disagreement with the outside counsel's position on this, and so we decided to look into this. Now, there was a correspondence between the CFO, Doug Tanner, and the outside counsel. The email was originally sent on December 15th. There was a response that was sent on January 7th, which I actually have a copy. And this is actually, the response is from the lead attorney, that was Norma Montague, and she actually notes in the email that the likelihood is probable and the estimated loss is reasonably estimated at $500,000.
Yeah, so taking into account her response and the guidance of US GAAP, we do recommend that you do book this, and it would be a $500,000 liability on your balance sheet and a $500,000 loss on your income statement.
Yeah, I guess that's one thing that we're struggling with, and I hear you on the points you just made, but I guess management and our internal counsel are kind of saying, well, we're not really sure that it's probable that we're gonna incur the loss. So maybe there's a bit of a disconnect that we have to kind of reconcile.
You guys certainly have the right to speak with your outside counsel a little bit more, but in our requirements as auditors, if the outside counsel does say that it is probable and it is estimable, we do request that you guys do book it. In the case that you guys do get a favorable outcome later, we can absolutely reverse this entry. But for now, for us to sign off on the financial statements, we request that you do book this.
Well,
And
I
that-
think we'll table this offline and maybe review it internally.
Yeah,
Sure.
absolutely. We'll be happy to sit down with you in the future.
Sure.
So,
Alright, I would like to walk you through some additional auditing service, due to the acquisition of 2ORourke. As you see, you incurred some additional goodwill on the balance sheet, and the assets went up from 349 million to 655 million after the acquisition. As an auditor, we're required to perform two additional auditing service. The first one is a one-time service after the acquisition. We will review how Fox allocates the purchase price among the intangible and tangible assets, such as equipment, property, trademarks, patents, if there's any. This asset allocation is important because any write-up of those assets now will incur as depreciation or amortization expense in Fox income statement in the future. So we want to make sure your company get the right amount for those assets now, so we don't have to make future adjustment. A second service we want to offer is the annual service to review your goodwill impairment test. Each year, your management will do a goodwill impairment test to ensure the goodwill sits on your balance sheet is accurate. And as an auditor, this is our responsibility to make sure you incur the right amount.
So you're saying
Right.
you're saying purchase price allocation,
Mhm.
I heard you say, and then an ongoing goodwill impairment. So those are the two main areas of increased audit effort for the most part.
Maybe.
Yeah.
I'm sure there'll be other work to follow, but yeah.